Hi everyone. Welcome back to Saving Sense. Today, we're diving into a topic that affects us all, interest rates. Whether you're saving money, taking out a loan, or just trying to understand the economy better, interest rates play a crucial role. So, let's break it down together in this beginner's guide to understanding interest rates. Understanding interest rates, a beginner's guide. What are interest rates? So, what exactly are interest rates? In simple terms, an interest rate is the cost of borrowing money or the reward for saving money. When you take out a loan, you pay interest. When you save money in a bank account, you earn interest. It's expressed as a percentage of the principal amount, which is the initial sum of money. Definitions and basic examples. For instance, if you borrow $1,000 at an annual interest rate of 5%, you'll pay $50 in interest over a year. Conversely, if you save $1,000 in a bank account with a 5% interest rate, you'll earn $50 over a year. Types of interest rates. Now, let's talk about the different types of interest rates. The two main types are simple interest and compound interest. Simple interest formula. Simple interest is calculated only on the principal amount. The formula is \text a simple interest a equals \text principal a \times \text a rate a \times \text time a \. For example, if you invest $1,000 at a simple interest rate of 5% for 3 years, the interest earned is $1,000 times 0.05 times 3 equals $150. Compound interest formula. Compound interest, on the other hand, is calculated on the principal amount and also on the interest that has been added to it. The formula is \a equals p1 plus \frac r in caret ant a \, where \a is the amount of money accumulated after n years, including interest. \p is the principal amount. \n is the annual interest rate. \n is the number of times that interest is compounded per year. \t is the time the money is invested or borrowed for, in years. For example, if you invest $1,000 at an annual interest rate of 5%, compounded annually for 3 years, the amount is \a equals 1,000 left, 1 plus \frac a 0.05 a 1 a \right, caret 1 times 3 I equals 1,000 left, 1.05 right, caret 3 equals $1 157.63 How interest rates are determined. So, how are these interest rates determined? Central banks, like the Federal Reserve in the United States, play a significant role. They set the base rate, which influences the interest rates that banks offer to customers. Factors that influence these rates include inflation, economic growth, and monetary policy. 1. Inflation *. When inflation is high, central banks might raise interest rates to cool down the economy. 2. Economic growth *. In a strong economy, interest rates might be higher to prevent overheating. 3. Monetary policy *. Central banks adjust rates to either stimulate the economy or curb inflation. The impact of interest rates. Interest rates have a profound impact on various aspects of the economy and our daily lives. 1. Loans and mortgages *. Higher interest rates mean higher costs for borrowing. This can affect decisions on buying homes or cars. 2. Savings *. Higher rates can lead to better returns on savings accounts and investments. 3. Investment * companies may invest less in expansion when borrowing costs are high. 4. Stock market * interest rates can influence stock prices, as higher rates might make bonds more attractive than stocks. Let's look at some real-life examples. 1. Buying a home * suppose you're considering a mortgage. A lower interest rate reduces your monthly payments and the total cost of the loan. 2. Saving for retirement * investing in a retirement account with compound interest can significantly grow your savings over time. 3. To credit cards * understanding the interest rates on credit cards can help you manage debt more effectively. Tips for managing interest rates. Here are some tips for managing interest rates in your personal finances. 1. Shop around * compare interest rates from different lenders before taking a loan. 2. Pay off high-interest debt * focus on paying off high-interest debt like credit cards first. 3. Save and invest wisely * look for savings accounts and investments with favorable interest rates. 4. Understand the terms * always read the fine print to understand how interest is calculated and compounded. Conclusion. Understanding interest rates is essential for making informed financial decisions. Whether you're borrowing, saving, or investing, knowing how interest works can help you manage your money more effectively. To recap, interest rates are the cost of borrowing or the reward for saving. They can be simple or compound. Central banks influence rates based on economic conditions. Interest rates impact loans, savings, investments, and the economy. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe to Saving Sense for more financial tips and guides. And don't forget to hit the notification bell so you don't miss any updates. Leave your questions and comments below, and I'll see you in the next video.